for the time today. I'm not going to lie, this feels very weird being in person. Typically, I do these presentations the last 2 years in my shorts and in my son's bedroom. And so not hearing him scream right now feels very uncomfortable. But we're going to get through this together because conferences are back and it's really awesome to see people in person today. And so what we wanted to do today really is talk about the portfolios of the future. Right? What are we seeing from financial advisors? What are some of the best practices we're seeing specifically around the investment case for factors and how it can add maybe potential, I would call conversational alpha with your client. And so I'm joined today by Mark Carver, the Global Head of Equity Factor and Portfolio Management at MSCI, Lindsay Dia, one of the Senior Client Portfolio Managers here at BlackRock for our custom models business, and Luke Smart, our Head of US iShares Sustainable and Factor Strategies. Luke's actually my boss, so if there's any layup questions, please send them his way. We've got our year-end reviews coming up quite soon. So maybe I could just get started quickly here. Maybe we could level set. Mark, you've been in factors for some time. Maybe you could explain what are factors, why are they important in today's environment?
Sure. So I think you just called me old. So
you're the oldest one.
So that's awesome. Good start. So first of all, it's great to be here. Thanks for having me. I think factors are probably very familiar to everybody in this room, right? You think about investment styles, value, growth, quality. These are standard things that you include. But when we think about the definition of those, they're very simple. They're investment characteristics that help us understand the risk and return of a stock. What it allows you to do is then better isolate specific themes you might want to have in your portfolio, capture those in a very disciplined way, and ultimately try to generate a return. Many of our clients use factors as core parts of their asset allocation. They want to use them to try to get transparency into what's driving the prices that they're looking at on their screens, and they use them to express an investment view. Maybe you want to tilt to a particular idea because you think that the current macro environment will favor that idea, and you're going to tilt to that by maybe overweighting that idea and underweighting something else. But at the end of the day, they're just investment characteristics that allow you to better understand the prices you see on their screen, on your screens, or as we like to say, the risk and return of the assets that you're managing.
Yep. You mind if I come in there something?
No, please.
We're both old, but I keep my hair shorter, so it's harder to tell. Okay, so factors are tools, first and foremost, right? They're tools to manage your portfolio, to dial in your portfolio for your clients, right? And what are they tools for? They're tools for managing the risk and return of the portfolio. So I'll back up. One of the really neat things about factors is the relationship between risk, relative risk to the market, and return is very, very direct. So you've got a client who, like my dad, for example, is looking for a portfolio that really has some juice to it, that wants to outperform. We're going to lean into single factor exposure. Or, for example, if you have a client that's more like my mom, who wants to dial back a little bit of risk, well, we can lean into MinVol, and we can control the overall risk of the portfolio. The neat thing about factors is you don't really have to apologize for them. Once you can understand what they are, and once you can communicate that these are just tools to understand risk and return, distinct from like just performance measurement, like just tools for risk and return, it makes the conversation with your clients really, really easy, right? We understand that there's a positive expected return. We understand this is why there's a positive expected return. But we also understand that there's risk in markets. Sometimes it pans out, sometimes it doesn't, but we have that underlying thesis. You don't have to apologize for a particular manager and debate whether or not that manager still has it, whatever it is. Mm-hmm. You simply revisit the original case for why you took that level of risk, why you pursued that level of return, and revisit whether or not you believe that factors still work. And I've been doing this for 20 years, and I've never found a market where they don't. So at the heart, it's a tool for you to ultimately create the right portfolio, deliver the right experience, manage your business in a very consistent manner for your clients.
Perfect. Well, Mark and Luke, you both touched on one thing around themes in markets, right? And not shocking, I think in today's market, I think the two major themes are volatility and inflation. Given that factors can be used as a way to express views, what are you guys seeing from advisors, from other clients? What maybe historically, what factors have done well in this type of environment in the past? Maybe Luke, I'll kick it to you first.
Sure, sure. Okay, so there are two components that I think you want to think about when it comes to factors. The first is like, what do I expect to get from from stocks in the world? And then the second is like, what sort of risk do people expect in the world? And those two things can drive not just what allocation you want for your client, but they can also drive your expectation on where you are in the economic cycle and which factors to deploy to them. For example, value tends to do really good out of a recovery, right? And we've seen value actually perform really well, particularly in the beginning of this year. We saw one of the largest value prints since the Korean War in January. Why? Because people felt confident, right? Now, in March, we saw a loss of confidence. It turns out there's this gentleman named Putin who, I don't know, you probably noticed it in the news. When that came on, what we saw was a huge spike in variability in the market. And where do we see investors go? We saw investors reach towards managing the risk of their portfolios, right? More like my mom in that example. So we saw a huge uptick in the interest in minimum volatility. What does min-vol do? Well, like I tell Bob all the time, min-vol is going to min-vol. What else did we see do really well? We generally saw momentum do really well, right? In trending markets, even when markets are trending down, a momentum strategy will rebalance towards those securities which tend to outperform. And that outperformance tends to persist into the intermediate future. And we saw that happen once again.
Yep. If you think about that, and then maybe building on that, that is what we're seeing today. The question might be, what did we expect to see? And that's what sort of looking at long-dated research will tell you. Just by a show of hands, how many of you are worried about inflation? Okay, I'm shocked that like the hands didn't go like this. So you're probably worried about inflation, but you're equally worried about economic growth. And the fact is, when we think about this question of how certain investment styles will perform, we think about it in two ways. You can take an economy where we mirror or we marry growth and inflation, and you define it in two states. An economy where we see inflation rising and economic growth improving. Let's call that heating up. Then you have an economy where you see weakening economic growth, but rising inflation. That's stagflation. That's what we're all worried about. So in those two states, what we would note is that in a heating up economy, historically, sectors that do well are including things like technology, probably doesn't surprise anyone, materials. In the factor space, what is done traditionally very well are small cap or size factors and value. We've seen that play out a little bit this year. In a stagflationary environment, what we see is that minimum volatility and yield tend to be the strongest performing factors historically. Now, what's interesting is, in both states, we have seen we did this study back to the mid-70s, we've seen quality and momentum perform very well in both stagflationary and heating up economies. Now, curiously, bets that you probably often see managers make will be tilts to sectors. In a stagflationary environment, the sectors that do well are sectors with pricing power, energy, healthcare, utilities, things like that. But there is no sector that does well in both a heating up and a stagflationary economy. What that means is the bets that you often make, or your managers make, which is to tilt to specific industries or sectors, is a risky bet because you have to be very confident on the macro state. We're making that same bet on the factor side. There are factors that do well in both scenarios. So you don't have to be quite as confident in that bet you're making on the macro economy. But what's interesting is this long-dated research told us that what is performing well this year, we would have expected it to be. So to Luke's point, minimum volatility has been a stellar performer this year on a relative basis. Value outperformed growth in the first 6 months of this year by the highest level since the 1970s. That's an extraordinary outperformance. Value's been a great winner. In the last few weeks, in the last few months rather, momentum has been the story. Why? Because now we're seeing some of the economic themes be more persistent. That's a good economy for momentum. So what Luke said paid off this year, we could have expected based on looking at that long-dated research.
No, absolutely. And just to summarize, I think the two themes that we're seeing, again, inflation and volatility, If you're thinking about volatility, minimum volatility strategies, I think make a ton of sense here. We've seen $9 billion flow in since Q1. And then the value story, right, for inflation. So the question I get is, how do I explain this to my client, this value versus growth debate that we're hearing on CNBC every day? And the way that I like to explain it, I think, and I think it helps tell the story, is you want to think about it as short duration assets versus long duration assets. Right, so think of growth stocks as long duration assets. You're being paid for the cash flows in the future versus value companies you're being paid for the cash flows today. And so in a rising rate environment, a high inflation environment, those long dated assets, growth stocks, should underperform, and that's what we've seen so far this year and really at the start of last year. So maybe we could pivot away from some of the investment case here and talk about the practice, right? I think the theme of this is managing $1 billion practice. Luke, Lindsay, you both have worked a ton on building portfolios for advisors. Maybe you could talk about why factors can play a role there and what you're seeing in the space. Lindsay, maybe I'll kick it over to you, and then we could go to Luke.
Absolutely. So on the custom model side at BlackRock, most of our clients are in the $1 to $3 billion RIA level. And we also work with a lot of clients who are just getting to that $1 billion assets under management mark. And I think regardless of the type of firm we're working with, we really see a common trait across all of these types of firms that around that $1 billion mark, there's a fork in the road. And essentially, they find that the business practices and the strategies that they use to get to the first $1 billion really is not going to be the same strategy that they use to get to 3, 5, and even beyond that. And things like trading, account management, client servicing, all of these different components become really unwieldy, right? When you're talking about maybe you start out with 100 really unique client accounts, now all of a sudden you have 10 times that. So clients partner with us at BlackRock in the custom models business specifically to essentially be their outsourced CIO, but really closely partner with their investment team. So we work with clients to develop custom portfolios that are white labeled, that have unique client preferences that really can't be found anywhere else. So what does this all have to do with factors? Obviously, when you're choosing vehicles, whether they're factors, index-based ETFs, or active mutual funds, that's a really important part of the investment process. So we at BlackRock obviously have a investment process that we stick to pretty religiously, and part of that is using factors as vehicles. We tend to use them tactically. So as both Mark and Luke mentioned, most of the tactical movement that's happened over the last couple of years has been a factor rotation that's pretty significant, from value and size to growth and min-vol momentum. So we use factors tactically, and I think whether you're looking to partner with a firm like BlackRock or another firm to build custom models, or you're looking to just have an in-house model that you're running, having models as some portion of the practice really is quite important when you're getting to that $1 billion mark. And so I think factors, give us a really transparent and precise way to reflect those tactical views. Think of a scalpel versus a chainsaw, right? We're able to actually be really precise in our factor views using these vehicles. And I think whether, like I said, whether you're partnering with an outside manager or running models in-house, using factors can be a really important part of that disciplined investment process.
Well, you kind of sold me a chainsaw. That sounds kind of cool. Factors are a little bit more of a scalpel. Yeah, I won't tell the story about my wife and the chainsaw and my neighbor's tree, but it was a good story. Scale. Scale, 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 scale. Factors give you scale. They give you one story, right? They give you one strategic allocation. They help you manage operational risk. They do it incredibly cost effectively, a fraction of the cost of a typical active manager. They let you dial in exposure for what your client's objective is, what their risk tolerance is, what their perceptions of the market is, right? You get all of that in addition to scaled implementation of your tactical ideas. And if you get somebody like Lindsay helping you out, you get even more scale with somebody managing that for you. In addition, I mentioned it already, factors is these things have been around. I said I've been doing factors for 20 years. Factors have been known since the early 80s. Arguably before that, if you want to go back to Graham and Dodd, right? But Rolf Banz, if you're into this sort of thing, dropped the small cap research that was initially capitalized in 1981. That's when the first real implementation of factors from a performance perspective went into markets. Value and growth from a performance factor perspective was the early 90s. Mixing these things up, right? That became a concept in the early 2000s. That's these multi-factor approach. Makes great strategic core allocations. What all these things do, how do they help advisors? What are the best implementations that I see? They're ones that deliver scale, having consistent narrative, managing your operational risk, controlling cost, controlling your story. That's the real benefit of factors from an advisor's perspective.
So speaking of scale, and I liked how the previous speaker said that he's going to do a sales pitch. I'm going to do the sales pitch here now. Just a quick.
So your bonus just went up.
Yeah, exactly.
So
no, I'm trying to get paid this year, guys. I have a 2-year-old, and it's very expensive.
He's hungry. I've seen him.
He's a big boy. So just a quick question for the audience. How many people enjoy finding the estimated capital gains of their mutual fund providers? Nobody? It's easy to find. There we go. Mike Durso, everyone. So it is the hardest thing to find. So I actually used to run portfolios for another asset manager. And the hardest thing to do is navigate that website to find that random PDF of that estimated capital gain. And so one thing that I actually, when I was a client of BlackRock's, the number one tool that we used was our tax evaluator. And so what that does, if no one's used it in the audience, it actually scrubs all of that data across the industry and will tell you, you could plug in your mutual funds, your ETFs, what is the estimated capital gain, when is it going to pay, how many days you have to sell, and this is the part for my bonus, what factor ETF you should buy to replace that for the 30-day wash sell rule. And so if there's one thing that you could take away from this, I promise you it will save you hours of time trying to find it. It gets updated daily. I think there's like 5,000 mutual funds that have already reported their estimated capital gains. But to me, that is the number one way we're seeing people scale their business. You know, I've seen advisors come with 150 tickers, right? Across, it was models, it was some random assets that they came to them. They were able to actually just download that, put it into the tool, and instantly have a report spit out every week on what those estimated capital gains and consolidate their business to a more manageable practice, you know, from a due diligence perspective. So from a scale perspective, to me, that is the number one tool that we have at BlackRock. And I'm happy to send that over if anybody wants it after the presentation. So maybe closing us out, you know, one thing that, you know, we talked about why factors, maybe some of the scale. When thinking about selecting factor products, right? There's hundreds of products in the industry here. Lindsay, I know you do, you know, due diligence when thinking about portfolios, but what are some things that advisors should think about when selecting specific products? And then Mark, you could close on that as well. That'd be great.
So I'll let Mark cover all the difficult pieces around selecting factor products and getting really detailed there. But as a PM, I'll just share how we think about actually selecting factor products. And obviously there's things like tracking error and how are you measuring the factor, and I'm sure Mark's gonna cover all that good stuff. But how we actually think about it is the first decision, is it a strategic or a tactical view you're trying to implement? And so in our models team, we've used factors for both. I would say more recently, for obvious reasons, we've been usually using single factors for tactical views because the market's moving so fast that it's just more of a tactical position than it is strategic. I think the second point is, are you looking to have a single factor view or something that's more multi-factor? And I think it's closely tied to the first question, because if you're looking to have a single factor view, you really should be ready to kind of rebalance that, right? Is it a 6-month view? Is it 6 to 9 months? Is it 12 months? And so on. Because as we've mentioned a couple times, this rotation is happening relatively quickly. So if you would rather have something that's a little bit more set it and forget it, I think a multi-factor product makes a lot of sense. So I think that first question is really important. And then the third piece is, how does that position fit in the overall portfolio? We talk about risk a heck of a lot at BlackRock, especially in the custom models. We're managing everything versus a tracking error budget. So we need to know how that vehicle plays with everything else in the sandbox. So whether you're looking at traditional cap-weighted vehicles, you know, index tracking, sectors, active mutual funds, of course, all of that comes together, and we need to know what those underlying exposures are. So quick plug for some of the tools on BlackRock, we actually use Aladdin on the portfolio management side to measure risk across all of these different vehicles, and Aladdin is the same thing that powers the Advisor Center. So you can run reports on client portfolios, on model portfolios, and that's actually what we would do whenever we're introducing a new ticker. Like in October, we introduced US minimum volatility. We have emerging market minimum volatility. So we make sure that all of these things go together in the portfolio rather than looking at it as a standalone vehicle. I think that's really the most important thing to start with.
Yeah, and I think the difference in the way I would approach it is not so much the conversation of what role does the factor play, but then once you know that and you've answered that strategic versus tactical, you still have to pick a product. And you can obviously pick many, many products. And when it comes to factors, in some ways, people will say, how do I make that decision? I think it's fairly simple. When you pick an active manager, you probably look at people, process, performance. When you pick a factor, there's the same sort of framework. You think about what is the starting universe from which that's built? What factor definitions are they using? In other words, what measures are used? For instance, if you use a single dimension for value of price to book, you'll tend to have more of a junky portfolio. You'll tend to be concentrated in more industries and sectors. Is that what you want, right? And so what you want to think about is the universe, the descriptors or measures used, single versus multi-measures. Why? What's the evidence of those measures? What constraints do they put on the portfolio? Because anytime you have a rules-based methodology, you have side effects, right? It's not quite as bad as the drug companies when you see the commercials and you have the 30 seconds of a person speaking so quickly about all the side effects, but there are side effects. For instance, do you have a persistent bias towards something that you didn't intend to have in the portfolio? So you need to understand the constraints. How are the securities weighted? And what's the rebalancing frequency? Why does the portfolio turnover? And all of that allows you to mirror that same framework that you've used for years. It's universe, definition, constraints, weighting, and rebalance. And if you understand that, it's fairly easy to then look at the difference between one product and another. We've talked a lot about minimum volatility today. Let's imagine you use a volatility process where you just rank stocks by their volatility and say, I want to carve off the portfolio that from that universe have the lowest volatility. That portfolio will have massive sector biases. You'll be very concentrated in industries within those sectors. That's the side effect. Is that what you intended? You're also only looking at one dimension of risk, right? So you know that there are multiple dimensions of risk. For instance, the volatility of the stock and the stock's relationship to other stocks, i.e. its correlation. What we know is that if you look at a multidimensional framework, the risk of the stock and its relationship to others, you actually can reduce the volatility of that underlying portfolio. That's a smart decision to move away from a single, simple dimension to a multiple dimension framework that has real impact on the behavior of that asset, that minimum volatility portfolio. Understanding these things is very straightforward, but unless you put it into a framework, you may make decisions that you didn't intend or have exposures that you didn't want.
Perfect. Well, Mark, thank you for those, and Lindsay, thank you for those comments, and Luke. I think we have a minute or two for questions, but that's what we have for prepared. I'll see if there's any questions. If not, thank you guys for the time.
What are your thoughts on multi-factor for single?
Should I?
Yeah.
I'm a big fan of multi-factor. So multi-factor sounds like a big complicated word. I was in Mexico talking with our legal and compliance team debating the name for some of our stuff. Multi-factor plays an excellent role in the core of the portfolio. Mic dropped.
She literally dropped the mic.
All right, I'm done. Thank you.
We're just getting used to this. We've been used to Zoom for the last couple of years, but the mics are here now.
It plays a great role in the middle of your portfolio. So the nice thing about having multiple factors in the middle of your portfolio is that you can have a differentiated conversation. The trick is that you don't want to be making huge bets in the middle of it. So like that construction matters. So making sure that it's an exposure that is appropriate for the kind of strategic allocation, the kind of core that you actually want is really important. It's almost the canvas. Well, the blank portfolio is the canvas, but if we're doing happy trees and we're going to paint some mountains in the background, maybe like a nice river or something like that, that's going to be your core allocation. And then when you dial in, I don't know, sheep, I don't know what you put in these paintings anymore. What goes on a Bob Ross painting?
I don't know. I don't know.
When you paint that in, that's when you dial in the rest of
Not
your
that old.
portfolio.
Luke, not that
I was looking at Bob. You know, I figured he would know. He's cool like that.
I think we have another question here.
Could you talk a little bit about momentum by definition? Shouldn't momentum always be a part of a multi-factor portfolio?
Mark, maybe that.
Yeah, so is the question, shouldn't it always be part of a factor portfolio? Yeah, so the answer is maybe, right? It depends on your view, but I think momentum is probably one of the most misunderstood factors and one of the most interesting in that, if you think about the most raw, simplistic view of momentum, you buy winners, right? And what that means is it's agnostic to anything but winners. Now, the tricky thing is how do you define winning, right? And most momentum strategies are built on price momentum. And maybe the one drawback to that is that you can have large drawdowns in periods of heightened uncertainty or heightened volatility. And so momentum, if you are Rip Van Winkle, and there's a good storybook name for you, the fact is, over 20-year horizon, historically momentum would have been probably the strongest performer. But the path during that 20 years can be uncertain because of the drawdown. And so one of the things that we do at MSCI, and this is not intended to be an MSCI commercial, is we address the side effect of the drawdown of momentum by not using simply price momentum, but rather risk-adjusted price. And what that means is you systematically, in the portfolio, two names with the same momentum, i.e. price momentum, but one having more volatility will systematically be underweighted in the portfolio. The impact of that is that you get exposure to the winners, but you have lower drawdown during periods of uncertainty. We also do another thing which is called a conditional rebalance, which means you systematically turn over the portfolio in periods of high volatility. So you think about it as event-driven turnover, i.e. purposeful turnover. So oftentimes you'll hear from people who have factor strategies, and they'll talk about the turnover of the strategy because they can be high turnover, but the truth of the matter is there are periods where you want to turn over and take advantage of the opportunities the market's giving you. So the combination of a price, risk-adjusted price, plus the conditional rebalance takes away some of that volatility you see on the downside for the momentum strategy, at least in our index.
That's actually reminded me of a fun exercise. And you're right, like if you look at the historical premia, momentum is the highest. But here's a fun exercise. Maybe we'll make a slide of this one day. With perfect hindsight, go back and find the best performing whatever, however you want to define the market. Could be sector, could be factors, could be stock, could be manager, whatever. Just pick the best. And over that time period, map out their performance relative to the market. And it's going to be interesting when you do it, right? Because the portfolio is going to be kind of all over the place. There are going to be times when it looks great, incredible, because it's the best. It has to have good times. There are going to be times when it looks absolutely horrendous. Okay, so the question, the benefit of this exercise isn't the end state, because we know the end state, right? It's the past, it's written. The benefit of doing this exercise is asking yourself whether or not you could have tolerated that ride. Could you have handled that volatility? And if the answer is no, that wasn't the right exposure. You need something that's lower expected return, right? Lower risk relative to the market, and you can kind of dial that back. Now, that sounds like I'm just kind of telling an arbitrary story, riffing off what Mark said, because Mark and I are buddies. And in part I like telling stories. But that also begins to tell you what sort of portfolio you can form from a factors perspective, right? If you do this exercise and you think, whoa, that's crazy. Well, we know that momentum is the highest octane. It also tends to be higher standard deviation. maybe we dial back some of that exposure. Maybe we make the portfolio a little bit more market-like. So the answer is maybe. It depends on who you are and what your goal is and when you're trying to deliver it.
Yeah, and I think it's probably true that the most common core allocation for factors has historically been minimum volatility. And we see this across both institutional and wealth clients, right? That is a core position for many of those clients. I think that's probably uncontroversial.
Yeah, absolutely. Well, it looks like we're at time here. Again, thank you all for the time today. Thank you guys for joining us on the panel, and we'll be around if you have any questions.
Thanks, all.